Hello, everyone. Canada. Big news hit the housing market yesterday. The Bank of Canada slashed its policy rate by 25 basis points to 2.5%, the first cut in 6 months and the lowest in 3 years. With unemployment spiking to 7.1%, inflation easing, and U.S.-Canada trade tensions looming, this rate cut is like a shot of adrenaline for the economy. Some are cheering. My mortgage payments are finally dropping. Others worry. Will home prices skyrocket again? So, what does this mean for Canada's polarized housing market and your wallet? Let's break it down. How does the rate cut affect you? Floating rate mortgages, instant savings. Floating rate mortgage holders are the big winners here. These loans are tied to the BOC's policy rate, so the cut means immediate relief. August 2025 data shows a $20 to $30 monthly saving per $100,000 borrowed. For a typical $500,000 mortgage in Toronto or Vancouver, that's $100 to $150 less per month, enough for a nice dinner out. Fixed-rate mortgages, tied to long-term bond yields, around 3.8% in August 2025, adjust more slowly. Only new or renewing loans will see lower rates. One homeowner said, "Wish I'd gone floating. This cut's a game changer." Boosted buying power, a window for first-timers? Lower rates mean lower monthly payments, boosting your borrowing power. TD Bank estimates this 25 basis point cut increases affordability by about 5%. For example, a $500,000 condo in Toronto saves $150 monthly, while a $400,000 unit in Vancouver saves $120. Remax data. First-time buyers are excited, with some saying, "I'm finally booking home viewings." But with Canada's housing market split between icy and red-hot regions, timing and location are everything. Housing market, a tale of two Canadas. Canada's housing market is more divided than ever. The Canadian Real Estate Association, CREA, reports a 2.3% year-over-year sales increase in August 2025, but growth comes from outside Toronto and Vancouver. RBC forecasts a 5 to 8% national transaction surge in Q4 2025, yet outcomes vary by city. Toronto and Vancouver, still out of reach. Toronto's market is frozen. 98% of neighborhoods sold below asking in August. Condo sales plummeted 69%, and new project inventory would take 58 months to clear, with 55% of pre-construction condos unsold. CREA prices hit their lowest since April 2021. Vancouver's no better. August saw condo prices drop 4.4%, townhouses 3.5%, and detached homes 4.8% year-over-year, with declines accelerating from July. Average prices remain steep. $1,020,000 in Toronto, $1,150,000 in Vancouver. Remax predicts a 2 to 3% price dip in 2025, with no bottom in sight. High prices are driving residents away. Ontario lost 5,664 people and BC lost 2,357 in Q1 2025, the first quarterly population decline since 2020, Statistics Canada. A recent survey found 76% of immigrants can't afford housing, and 26% plan to leave within 2 years. Montreal and Calgary, the bright spots. Meanwhile, Montreal's market is sizzling. August sales jumped 12%, with single-family homes hitting a median of $633,250, up 7% year-over-year, and inventory at a tight 17,500 units. CREA. This seller's market could heat up further with the rate cut, but low supply risks fueling a price bubble, much like Calgary's past migration-driven boom. Calgary's market is balancing out, with 6,661 homes in inventory, 3.4 month supply, and a benchmark price of $577,000, down 4.1%. The rate cut could draw more buyers, stabilizing prices. Challenges to watch. Despite the optimism, hurdles remain. High unemployment. August 7.1% unemployment rate and 66,000 job losses hit manufacturing and retail hard, especially young workers, Statistics Canada. Shaky incomes make buying risky. Tighter lending. The BOCE's 2025 Financial Stability Report notes banks are prioritizing risk management. Mortgage delinquency rates are up. National banks by 59%, BMOs by 54%, against a national average of 21%. Over 60% of mortgages renewing in 2025 to 2026 face higher payments, with household debt to income at 185%. New immigrants face stricter lending criteria. Inflation risks. BOC Governor Tiff Macklem insists on a 2% inflation target. Housing costs drive 28% of CPI, and rising prices could reignite inflation, limiting further rate cuts. U.S.-Canada trade tensions may also spike prices. Your action plan. Floating rate mortgage holders. Cash in. Check your loan terms and use savings to pay down principal or invest. Consider fixed. Lock in low rates if inflation worries you. Fixed-rate mortgage holders. Time renewals. Shop around at renewal to snag lower rates. Tracking 3.8% bond yields. Plan ahead. New buyers should lock in fixed rates to dodge future hikes. First-time and essential buyers. Budget wisely. Factor in property taxes and insurance, not just lower payments. Pick smart. Montreal and Calgary offer lower prices and growth potential, unlike Toronto and Vancouver. Wait for signals. Toronto and Vancouver haven't bottomed out. Watch for falling inventory and rising sales. Investors. Weigh returns. Low rates cut borrowing costs, but beware price swings and vacancies. Bet on winners. Montreal's 17% rental yield growth and Calgary's steady demand outshine Toronto's high inventory. What's next for housing? The rate cut injects energy, but results vary. RBC projects a 5 to 8% transaction boost in Q4 2025, with Montreal and Calgary prices up 3 to 5%, while Toronto and Vancouver may dip 2 to 3%. If unemployment stays high, 7.1% plus, buyer confidence could falter. Macklem cautions, monetary policy can't fix housing supply. Governments must build more. The market's shifting from investor-driven to owner-occupied, reshaping prices and trends. All right, that's it for today. Will the rate cut bring prices down or push them back up? I'd love to hear your take in the comments. And hey, if you want more real estate updates like this, hit that subscribe button and join our growing community. See you next time.